DeFi promises permissionless community-led financial systems, but many projects still rely on token-based voting, off-chain coordination, and upgrade keys that can be misused. These weaknesses create real governance risks, from Sybil attacks to proposal manipulation and unclear accountability. As regulators push for same risk is equal to same rule, DeFi may be pushed toward more centralized structures, reducing the decentralization it was built on. In today's video, we'll break down all these risks in detail, so make sure to stick with me till the end. Number 10. Token concentration creates governance plutocracies. If a few wallets hold most governance tokens, those holders can control votes and steer protocol changes to their benefit. That turns an ostensibly decentralized project into something very much like a company run by major shareholders, and it makes hostile or self-serving proposals easier to pass. Research shows token ownership and voting power are often highly concentrated in DeFi communities. Number 9. Low voter turnout amplifies outsized influence. Many token holders never vote. When turnout is low, a motivated small group, or a single large holder, can decide important protocol changes. Low participation means governance outcomes rarely reflect the wider user base, and it creates an environment where coordinated attacks or bargains are cheap and effective. Number 8. Sybil attacks and cheap identity manipulation. Because blockchain identities are pseudonymous, attackers can create many wallets to pretend to be different voters, a Sybil attack, or use flash loan token purchases to gain temporary voting power. Studies flag these as real and common governance weaknesses that let attackers push harmful proposals or block defensive measures. Number 7. Vote buying, bribery, and dark DAO schemes. Market mechanisms and on-chain transparency make it possible to buy votes, directly or by paying others to delegate voting power. Emerging research and practitioner warnings describe systems where vote buyers coordinate privately, so-called dark DAOs, to capture governance, undermining honest community decision-making. This is a growing threat as tools to automate vote trading become more advanced. Number 6. Proposal front-running and opportunistic capital moves. Attackers can watch pre-proposal discussions or on-chain signals and then quickly acquire tokens or otherwise position themselves to benefit when a proposal passes. This proposal front-running turns governance into a financial arbitrage game, where the fastest, best-funded players profit at the expense of ordinary users. Several surveys and analyses have documented such front-running attempts in real governance processes. Number 5. Hidden centralization. Who truly controls upgrades? Many projects retain technical admin keys, multisigs, or guardian contracts that can change code or roll back actions. Even if token votes are nominally required, the existence of privileged signers or developer teams means ultimate control can sit off-chain or in a few hands. That opacity makes it hard to hold anyone accountable when things go wrong. Number 4. Composability and cascading governance failures. DeFi apps build on each other. Lending pools, oracles, wallets, and AMMs interconnect. A governance attack on one protocol, for example to change oracle parameters, can trigger losses in many linked systems. This composability multiplies the danger. A governance exploit can quickly become a systemic economic event. Number 3. Economic incentive misalignment and short-termism. Governance token economics sometimes reward speculators, not long-term users. If voters are mainly traders chasing quick gains, proposals that harm long-term health, but raise short-term price or yield, can pass. Designing token incentives that align with sustainable governance remains one of the hardest practical problems for projects. Number 2. Legal and regulatory risk. Same risk equals same rule pressure. Regulators and policy groups are increasingly treating DeFi activities like traditional financial services when the risk looks the same, meaning DeFi protocols may face licensing, compliance, or enforcement obligations. If regulators apply same activity, same risk, same rule broadly, projects might be forced to centralize or use intermediaries to meet legal standards, which undercuts decentralization and raises accountability questions. Recent policy reports and industry analyses emphasize this regulatory trend. Number 1. High-profile governance incidents and what they reveal. Real incidents show theory becoming reality. Coordinated capital accumulation, exploitative proposals, and rushed upgrades have already caused large losses or messy forks. Well-documented governance incidents highlight how easily design gaps, low turnout, concentration, privileged keys can be exploited, and why governance design needs continuous, realistic stress testing. One recent protocol example involved a well-resourced actor coordinating governance attacks by accumulating power and pushing self-serving changes, showing these threats are not just theoretical. Practical takeaways. Governance in DeFi is a live experiment. It brings big benefits but also real, evolving risks. Teams should design for broad participation, limit single-party powers, harden against Sybil and front-running tactics, and align token economics with long-term users. Users and regulators will also demand clearer accountability. Understanding these 10 risks helps builders and users spot vulnerabilities early and push the space towards safer, more resilient governance. That's all for today's video. If you found this video useful, make sure to subscribe, drop a comment, and tell us what topic you want covered next. Thanks for watching. Have a wonderful day.